This morning's release of core PCE, the Fed's preferred inflation gauge, showed prices rose at an annual rate of 3.3% in April, a nearly three-year high. Let's bring in Joe Lavorgna. He most recently served as Treasury Secretary Scott Bessent's economic counselor. Joe, great to have you with us.
Great to be with you. Thank you.
Why at least 100 basis points?
Because if you look at core inflation from where it was before we attacked Iran, it's going to be up at least 100 basis points. So in simple, basic math, your real interest rate has collapsed 100. You'd want to offset that by raising the funds rate at least by that amount. And, of course, as you said at the highlight at the beginning of the show, these equity averages are at all-time highs. The credit spreads are super tight. The dollar is, high but not excessively high. There's no tightening of financial conditions, and the inflation numbers, the 3- and 6-month change show inflation moving up towards 4%. So what's going to force that back to 2%? It won't happen magically.
How urgent is your call for at least 100 basis points? In other words, if the Fed stands pat, which it might very well do for the next couple of meetings, is that going to be a policy mistake looking in the rearview mirror?
Maybe. It's hard to say because at some point you could make the argument that Kevin Warsh is going to make, which I understand, which is this, we're going to increase the supply side of the economy, shift that aggregate supply curve down and to the right. That will increase growth and lower inflation. That's a legitimate forecast. They could wait in the short term because market-based expectations, inflation expectations are contained, and you haven't seen an acceleration in wage growth. But, Melissa, if either of those two developments change, there's going to be tremendous pressure on the Fed to hike as soon as September. I think Kevin Warsh will do a very good job and will push back against it. But if the economy is growing reasonably well and inflation is moving further away from target, why wouldn't you be hiking?
What happens to the bond market? By the way, Joe, I appreciate that. We've been talking about this on not 100 basis points, but the need for a hike instead of a cut. What happens to the bond market under the set of circumstances you're putting out there? I think it would be positive for the bond market.
Won't be positive initially, Guy. I mean, we did price about a tightening and a half a few weeks ago, a week or so ago, when 2-year notes got up to around 4.25. I mean, the curve will bear flatten, so your short rates will move higher than long rates. Long rates, maybe you could push back to 4.75, 4.80. I don't think they'll go to 5%. So the bond market will suffer. But the way the Fed will do it is they'll make sure there's a consensus. It'll be well telegraphed. The bond market, I think, will do reasonably okay. It won't be until the market thinks the Fed's done or they actually reverse course and ease that you see a big rally in rates.
So, Joe, when you look at this, it's inflation is either a demand pull or a cost push. Right?
Or it could be both.
So it could be both, right? So it could be. So I sense that that's probably where you're at, that it is both.
Actually, and I actually don't think it is. And this is the problem because I was very much in the disinflationary boom camp on February 27th before the U.S. went into Iran. This is now really the economy's doing okay. You've got this inflation shock, which is going to play out, I think, a lot like post-COVID, where you've got not just energy costs, but fertilizer, nitrogen, helium, these other products, and it's a supply chain disruption. So it's not just the demand pull cost push, which is actually happening on the data center AI build out, which is pushing energy costs higher, but rather just the supply chains, the fragility of these supply chains likely to continue to push prices higher. You see it in a variety of survey data. That, to me, is what the market is missing.